7 assets most Americans own are losing value faster than they earn. Robert Callahan spreads 4 pieces of paper across his kitchen table the way a surgeon lays out instruments. Reading glasses pushed up on his forehead. Yellow legal pad off to the side, half filled with numbers he's been running since 6 in the morning. The first document is a trade-in quote from a Chevrolet dealership 15 minutes from his house in Cleveland. He bought an Equinox EV 18 months ago for $48,000. The quote says $14,200. He reads it twice. The second is a Zillow screenshot his wife printed yesterday. Their neighbor, same floor plan, same lot size, same cul-de-sac, listed for $40,000 less than what Robert assumed his own home was worth. He hasn't checked his property tax assessment. He's not sure he wants to. The third is his pension statement. Robert has worked in logistics for 32 years. The fund is 73% funded. For every dollar he was promised, 73 cents exist. The other 27 cents are a projection, a bet that the market will close the gap before he retires. The fourth is a brokerage statement. $180,000 in long-dated treasury bonds, the allocation his financial advisor called the safe part of the portfolio. Current market value, $151,000. Robert doesn't panic. He's not the type. He pushes his glasses back down, picks up his pen, and starts writing. Every asset on this table is shrinking. Not because of a crash, not because of fraud, not because Robert made a mistake. He did everything the system told him to do. He saved. He invested conservatively. He bought a home in a stable neighborhood. He got a degree. He stayed with one company. He followed every rule. This is not a story about Robert. This is a story about 7 bets the American middle class has made without knowing they were bets. And right now, in early 22-6, all 7 are losing. This is Wealth Historian A, where we document how money quietly changes hands. The transfer happening right now isn't dramatic. It's arithmetic. Most people think they own assets. A house, a car, a pension, a bond, a savings account, a degree. They see numbers on a screen and assume those numbers represent safety. They don't. What they actually own are claims. A claim on a currency that loses purchasing power every year. A claim on a pension fund that may not have enough to pay. A claim on a housing market that assumes someone else will pay more. A claim on a technology cycle that's already moved past what they bought. Claims have an expiration date that nobody prints on the statement. You weren't told these were bets. They were sold to you as cornerstones, as foundations, as the responsible choices. But every single one depends on a specific condition remaining true. A condition already shifting. That's not a portfolio. That's a prayer. Here are the 7 assets, and here is why every one of them is a bet you didn't know you were making. The first asset, and the most visible one, is the vehicle in your driveway. Most people understand that cars depreciate. What isn't common knowledge is how fast that depreciation has accelerated, particularly for the vehicles the market told you were the future. Electric vehicles lose an average of 57.2% of their value within 5 years. The overall market average is 41.8%. That's not a gap, that's a canyon. A Nissan Leaf bought new loses 63% of its value in 5 years. A Tesla Model S, 62%. A Volkswagen ID4, 62%. A Model S starts around $80,000. 5 years later, it's worth roughly $30,000. $50,000 gone. The depreciation isn't driven by wear, it's driven by obsolescence. Every year, battery range improves, charging infrastructure expands. Manufacturers release updated models with longer range and lower sticker prices. Tesla has cut prices repeatedly, and every cut craters the resale value of every Tesla already sold. This is the Ford Edsel problem at digital speed. In 1958, Ford released the Edsel, A car that was technically fine, but immediately obsolete in the eyes of a market that had moved on. It lost nearly all its value within 2 years, not because it broke, because something newer made it irrelevant. That's happening now, across every EV brand, every model year, every quarter. Technology that improves fast destroys the resale value of everything that came before it. Check your trade-in value tonight. Then check what you still owe. The gap between those two numbers is the bet you made, not a bet on the car. A bet that technology would slow down. It didn't. The second asset is one most people don't think they own, but they almost certainly do. Commercial real estate. If you have a 401k, a target date retirement fund, or an index fund, part of your money is likely allocated to commercial real estate investment trusts. You may never have set foot in a Class B office building in downtown Dallas or a suburban office park outside Atlanta, but your retirement account has, and those buildings are emptying. The national office vacancy rate in early 2006 sits between 17 and 18%. In some cities, it's above 25%. New office construction has dropped to historic lows, not because demand is recovering, but because developers know it isn't coming back. Remote work didn't dent the office market. It restructured it. The question is no longer whether employees will return. The question is whether the buildings they left are worth what the loans against them assume. In the 1990s, a similar structural shift hit commercial real estate during the savings and loan crisis. Over 1,000 financial institutions failed between 1986 and 1995. The trigger wasn't exotic, all loans backed by commercial properties no longer worth what the books said. The FDIC resolved every single one. Japan tells the same story at larger scale. After the asset bubble burst in 1990, commercial property values in Tokyo dropped roughly 80% from peak. Office towers that had been collateral for billions became liabilities overnight. Japan still hasn't fully recovered. 3 decades later. Now look at the current wall. A massive volume of commercial mortgages are maturing in 2025 and 2026. The buildings behind those loans have fewer tenants, lower rents, and higher vacancy than when the loans were written. The owners need to refinance. The math doesn't work. An office building is a bet on how people work. How people work just changed. Permanently. Your retirement fund doesn't tell you which buildings it owns. It doesn't send you a vacancy report. It shows you a number on a screen, and you assume that number is solid. The third asset is the one your financial advisor calls the safe part: government bonds. In March of 2023, Silicon Valley Bank collapsed. Not because of fraud, not because of bad loans, because it held long-dated government bonds. The exact instrument every portfolio manager in America calls the bedrock of conservative investing. SVB had purchased billions in treasury securities and mortgage-backed bonds when interest rates were near zero. When rates rose, the market value of those bonds dropped. On paper, the bank still carried them at cost. The accounting rules allowed it. But when depositors pulled their money and SVB had to sell, the unrealized losses became real. $21 billion in bonds sold at a $1.8 billion loss. The bank was gone within 72 hours. SVB was not unique. According to FDIC data from the third quarter of 2023, American banks collectively held approximately $620 billion in unrealized bond losses. $620 billion sitting on balance sheets, carried at cost, invisible to anyone who doesn't read the footnotes. History has shown where this leads, and it doesn't always stop at banks. In Weimar Germany, government bonds, the instrument of absolute safety, became physically worthless. By November of 1923, 4.2 trillion marks equaled $1. Bondholders who had trusted the government's promise discovered that promise was denominated in a currency the government was printing into oblivion. Argentina has defaulted on its sovereign debt in 2001, 2014. In 2020, each time bondholders, pension funds, retirement accounts, individual savers received cents on the dollar. Each time the bonds had been rated, reviewed, approved by advisors. A government bond is a promise, denominated in a currency the government controls. You can trust the promise. You cannot control the currency. If your retirement portfolio holds 30 to 40% in bonds, the standard conservative allocation, you are not in a safe harbor. You are in a bet that interest rates will fall, that inflation will cool, that the currency will hold, and that the government's ability to service its debt will remain intact. 4 simultaneous bets, wrapped in one product, sold as one word. Safe. We're not even halfway. And notice the pattern. Every asset on this list was called safe by someone who sold it to you. The car dealership, the real estate fund, the financial advisor. The next 4 are heavier. The 4th asset is the one you were told not to worry about, your pension. In the United States, public pension funds carry between $1.27 trillion and $1.48 trillion in unfunded liabilities. That is the gap between what has been promised to retirees and what actually exists to pay them. The national average funded ratio sits at roughly 81 to 82%. Sounds close. It isn't. 80% funded means $1 in $5 promised to retirees does not exist. It's a projection, backed not by assets in an account, but by assumed future returns, future contributions, and future market performance. If any of those assumptions breaks, the gap widens. Stress tests from the Reason Foundation suggest that in an adverse scenario, total unfunded liabilities could rise to $2.74 trillion. Not in a generation. In a downturn. And downturns happen. Detroit filed for bankruptcy in 2013, the largest municipal bankruptcy in American history. The city's pension funds were underfunded by roughly $3.5 billion. Pensioners who had spent 25 and 30 years on the job had their benefits cut, cost of living adjustments eliminated, health care restructured. Not because the city chose to punish them, because the money wasn't there. It happened before Detroit. In 1963, Studebaker, then one of America's oldest automakers, shut down its factory in South Bend, Indiana. The company had promised pensions to its workers for decades. When the doors closed, the pension fund had enough to cover workers already retired. Workers under 60 received roughly 15 cents on the dollar. Some received nothing at all. They had worked 20 and 25 years for a promise that evaporated on a Thursday. That case eventually led to the creation of ERISA and the Pension Benefit Guaranty Corporation, federal backstops designed to prevent exactly what happened at Studebaker. But backstops have limits. And limits have fine print. The PBGC itself has faced funding shortfalls. The guarantee is only as strong as the institution guaranteeing it. Greece tells the story at national scale. Between 2010 and 2015, Greek pensions were cut up to 40% under bailout agreements. Retirement incomes guaranteed by law were overridden by fiscal arithmetic. The promise exceeded the revenue. A pension is a claim on future revenue from an institution that may not have it. Look up your state's funded ratio tonight. If it's below 80%, your retirement isn't guaranteed. It's probable. And probable is not the word anyone used when they sold it to you. The 5th asset is the one hiding in plain sight: cash. Specifically, the cash sitting in your savings account earning 0.4 or 0.5% annually, while inflation runs between 3.5% and 4%. That's not saving. That's losing roughly negative 3% per year in real terms. $100,000 saved in 22 has the purchasing power of roughly $82,000 to $85,000 in 22/6 terms. You didn't spend it. You didn't invest it poorly. You saved it. And the system took a cut every single year. Silently, automatically, by design. The US dollar has lost approximately 85 to 88% of its purchasing power since 1971, when the Nixon administration ended the gold standard. Before that, the dollar was pegged to gold at $35 per ounce. That peg constrained how much money the government could create. When the constraint was removed, the currency was free to expand, and it has, steadily, relentlessly for over 50 years. Not in dramatic collapses, in quiet annual increments that most people never notice until they look at what a dollar bought a decade ago. The average annual inflation rate since 1971 is approximately 3.8 to 3.9%. Compounded over 5 decades, the damage is devastating. A dollar today buys roughly 12 to 14 cents of what it bought in 1971. Zimbabwe showed what happens when this mechanism accelerates. Between 2009, inflation peaked at an estimated 89 sextillion%. The central bank printed a $100 trillion note. It couldn't buy bread. In Venezuela, doctors with decades of education watched their lifetime savings become unable to cover groceries. Extreme cases, but the mechanism is identical. The only difference is speed. Saving in a depreciating currency is lending your purchasing power to the system eroding it. You are paid 0.5% for the privilege. The system uses your deposit to lend at 4, 5, 6%.
Great, thank you.
The spread is the transfer. It happens every single day. The sixth asset is the one that takes up the most space in your life. Your house. Not all houses. Specifically the oversized suburban home, the 4-bedroom, 3-bath, 3,000-plus square foot structure that American real estate culture has taught an entire generation to aspire to. Bigger house, bigger wealth. That was the formula. J.P. Morgan's housing forecast for 2026 projects 0% home price growth nationally. Not a crash. Stagnation. After a decade of homeowners counting on 6 to 8% annual appreciation, stagnation feels like a crash. And stagnation is the best-case scenario for certain categories. In the Sun Belt, Arizona, Texas, Florida builders overbuilt during the post-pandemic boom. New inventory is flooding slowed markets. In Florida, insurance costs have risen so sharply that some homes are uneconomical to own. The annual cost of insurance, taxes, HOA fees, and maintenance exceeds $30,000 on homes that may never appreciate. In California, homes in fire-prone zones are losing insurability entirely. No insurance means no mortgage. No mortgage means no buyer. No buyer means the house is worth whatever someone can pay in cash, significantly less than what the owner believes. During the 2008 financial crisis, the average American home lost roughly 33% of its value. In Las Vegas, homes dropped 62% between 2006 and 2012. In Ireland, entire developments, ghost estates, were abandoned. Prices fell over 50%. And then there's Japan. Rural and suburban homes are now literally worthless. The government gives away IKEA abandoned houses because demolition costs exceed the land value. In some cases, the government pays people to take them. A house is only worth what someone is willing and able to pay in a currency that may not hold. Your mortgage does not depreciate. The bank's claim on your income is fixed. If the asset falls and the debt stays, the gap is yours. The seventh and the one nobody sees coming, is not a financial asset at all. It's a credential, a degree, an MBA, a law license, a professional certification, the piece of paper that was supposed to be the foundation of your earning power. American students and their families carry approximately $1.77 trillion in student loan debt, according to Federal Reserve data. Second largest category of consumer debt in the country, behind only mortgages. And the returns on that debt are shrinking. The college wage premium, The additional earnings a degree holder makes over a non-degree holder has been declining for many fields. Law school graduates from bottom-tier programs face unemployment rates that would alarm anyone who saw the tuition bill. MBA programs costing $150,000 or more produce graduates who may take a decade to recoup the investment, if they do at all. And artificial intelligence is now automating the exact cognitive tasks those credentials were designed to certify. A paralegal drafts documents, AI drafts documents. A junior analyst builds financial models. AI builds financial models. A radiologist reads scans. AI reads scans. The credential was proof of capability. The capability is now a software feature. After the Soviet Union fell in 1991, engineers and physicists with advanced degrees drove taxis. Their credentials were real. Their expertise was genuine. But the system that valued those credentials no longer existed. The market had restructured overnight. The new economy, privatized, chaotic, connected to global capital, didn't pay for what the old economy had trained. A nuclear physicist with 30 years of state service had skills that were world-class and economically irrelevant at the same time. In Argentina, after the 2001 default, professionals, accountants, lawyers, architects watched their billing rates collapse in real terms. A consultation priced at 200 pesos stayed at 200 pesos, but the peso bought 60% less. The credential hadn't changed. The currency it earned in had. In Weimar Germany, the educated middle class was the demographic that collapsed fastest. Not the working class, not the ultra-wealthy. The people who had done everything right, according to the rules of the old economy. A credential is a bet that the institution backing it, and the economy valuing it, will still exist in the same form. The economy you trained for in 2010 or 2015 does not look like the economy of 2026. The degree you're still paying for may be the asset depreciating fastest, and it's the only one that doesn't show up on any balance sheet. Step back. Look at all 7. A new vehicle, commercial real estate, government bonds, a pension, cash savings, an oversized home, a professional credential. Not one of these failed because of fraud, mismanagement, or bad luck. They failed, they are failing, because the conditions they depended on changed. Technology advanced, work patterns shifted, currencies depreciated, institutions couldn't keep their promises, markets saturated. AI began doing what degrees used to prove you could do. Every safe asset is a bet on continuity, and continuity is the one thing no economy has ever delivered. This is not a coincidence. It is structural. The middle class holds these 7 assets because the system told them to. Save in dollars, buy a house, get a degree, invest in bonds, trust your pension, drive a new car, build a portfolio of safe things. The system that recommended these assets is the same system that reprises them. The people who design the financial architecture, the monetary policy, the interest rate cycles, the pension regulations, the tax incentives, the education financing, are not holding the same assets you are. The system doesn't destroy these assets. It reprices them. The people who hold them absorb the repricing. The people who designed the system have already moved on. This isn't speculation. It's arithmetic. It's documented history. And the pattern is operating right now, in 22/6, across every one of these 7 categories. Vanguard manages over $8 trillion. BlackRock manages over $10 trillion. Fidelity, State Street, Schwab, Between them, they hold the retirement savings of over 100 million Americans. These firms allocate your money across the same categories: bonds, real estate funds, equities tied to companies whose workforce holds these same credentials, cash equivalents earning less than inflation. None of these firms are doing anything wrong. They are doing exactly what they were designed to do, manage risk within the current system. But the current system is the thing that's repricing. When the system reprices, the managers adapt. The clients absorb. The Federal Reserve reprices your bonds and your savings simultaneously. Remote work repriced commercial real estate. Your 401 absorbed the vacancy. Tesla cut new vehicle prices. Your 3-year-old EV absorbed the loss. AI automated cognitive tasks. Your credential absorbed the redundancy. Insurance companies repriced climate risk. Your home equity absorbed the adjustment. This isn't theory. It is documented behavior. Every asset on this list sits inside a structure built for an economy that no longer exists in its original form. The gold standard ended. The office economy restructured. The technology cycle accelerated. The credential economy is being automated. The pension math stopped working. The housing bubble proved that square footage is not wealth. And the savings account, the most basic financial act a person can perform, erodes in real time against a currency losing value for over 50 years. And yet, most Americans will go to bed tonight believing their net worth is the number on a screen. A number that assumes continuity. A number that assumes the dollar will hold. A number that assumes the tenants will return. A number that assumes the pension fund will perform. A number that assumes the degree will keep paying. Every one of those assumptions is a bet. And every one of those bets is already in motion. It is now August 2026. Robert Callahan sits at the same kitchen table. The yellow legal pad has more pages filled now. He sold the Equinox at 15,200 Oz, 300 fewer than he expected, 1,000 more than the February quote. He didn't buy another EV. He leased a hybrid. The neighbor's house sold for 37,000 less than Robert's estimate. He hasn't listed his. He refinanced instead, but the appraisal came in flat. The pension fund's funded ratio dropped to 71% after a rough second quarter. Nobody told Robert directly. He found the update in a footnote of a quarterly statement he almost didn't open. The bonds haven't recovered. His advisor calls it strategic patience. Robert calls it waiting for something he can't control. Robert is not angry. He's recalibrating. He's learning something the system never taught him. That safety isn't a characteristic of the asset. It's a characteristic of the conditions the asset depends on. And conditions change. The system wasn't designed to betray Robert. It was designed to function. Functioning means repricing. Repricing means someone absorbs the change. And the someone, almost always, is the person who believed the asset was safe. Not because they were foolish, because they were never told it was a bet. Which of these 7 assets do you think is safest? Leave your answer in the comments, and then check in 12 months. If that kind of clarity matters to you, subscribing is the simplest way to see what's coming. The pattern has already started. Now you know where to look.